Hi everyone. This week I'm going to bring you up to speed on some of the things we found out from our new survey of investors. We do this survey twice a year and we get firsthand knowledge from investors on how they see the market evolving. This week I'm going to talk a little bit about what's happening with retail and hotel properties. So looking at the investor sentiment for retail, sentiment remains constrained. It's actually pretty low for retail properties, and it has been for the last few years. It really reflects what's happening in the media and how a lot of the perception is being driven by these ideas that are in headlines like a retail apocalypse and that type of thing, when in reality the underlying fundamentals and the metrics for retail are still holding pretty strong. Now, when you look at our company's forecast, they're a little bit more optimistic than that. Multi-tenant retail vacancy is tightening a little bit. It's at about 5.8% on a national basis, which has been trending lower over the last several years and is about on par with where we were at the peak of the last cycle. Rent growth is in the 2.5% range looking forward into 2019. The rent growth and the decline in vacancies alone imply that values will increase modestly in 2019, assuming cap rates remain flat. And they have been flat for the last 2.5 years. So we don't see anything that's really going to move that paradigm very much. Retail centers that will draw the most attention from investors have already made the transition to focus on services, restaurants, fitness centers, and experiential retail. Now, shifting gears to hotel investments, we've seen a steady decline in investor sentiment for hotels over the last few surveys. Right now, only 16% of investors plan to buy, 52% plan to hold, and 32% plan to sell. And this weaker sentiment reflects three important things. The first is that performance is at a record level. Occupancies are at a record level. ADR, average daily rate, is also at a record level and seen steady growth over the last few years. The economy has been growing for 9 years straight, and a lot of people are fearing a downturn. All they really see is downside risk, that the economy is going to slow down or performance is going to weaken from the peak levels that it's been. Now, what investors may not be considering is that we're catering a lot more hotels to millennials today because there is such a huge spending group and they travel a lot more than any prior generation. So there's a lot of opportunity for growth from millennial travel alone. And although the economy has been growing for 9 years, there's no indication that there's an impending downturn. A lot of economists are saying that there may be something coming in a year or 2 years, but really, when you look at the fundamentals, when you look at job creation, when you look at retail sales and consumption numbers, they're all still very positive. So when we look forward at the hotel forecast, we anticipate occupancy staying elevated at or near record levels. We also expect ADR growth in the 2.3% range, which is, again, a pretty strong momentum on pricing. Next week, I'm going to talk a little bit more about what's happening with apartments and what investors are seeing out there in that segment of the market. So for now, thank you.